Welcome to the Deep Dive, where we cut through the noise and give you the essential insights you need to be truly well-informed. Today we're doing a really comprehensive deep dive into, well, one of modern finance's most singular and fascinating companies, Berkshire Hathaway, Inc.
Yeah, our mission today is to really distill the most important bits from, all the detailed financial reports and the strategic analysis out there. We want to help you understand Berkshire's unique model, where its earnings actually come from, the quality of its management, which is pretty legendary, its incredibly strong balance sheet, and ultimately what it might genuinely be worth. Now, it's really important to remember this deep dive is based purely on publicly available sources. It's all for educational and informational purposes.
Exactly. This isn't investment advice, not under any circumstances.
Yeah.
We're here to inform, help you understand.
Right. But, the track record is just incredible, isn't it? Berkshire Hathaway has significantly outperformed the S&P 500 for decades. Oh, absolutely. The compound annual growth in market value between 1965 and 2023 was nearly 20%. Compare that to the S&P's 10.2% over the same time. It's quite remarkable.
It really is. Okay, let's unpack this. So, a lot of people know the name Berkshire Hathaway. But how would you actually define what it is? It's more than just a standard company, right?
That's a really crucial distinction, yeah. Berkshire genuinely defies simple labels. It's not your typical conglomerate trying to, force synergy between businesses.
Okay.
Think of it more like a highly decentralized investment vehicle, a holding company, essentially. The core strategy sounds simple, but it's incredibly effective. They acquire and then just hold businesses that have strong fundamentals, durable competitive advantages, what Buffett famously calls an economic moat.
Right, the moat.
Exactly. And critically, management teams with high integrity, that's non-negotiable for them. And the decentralization, it's extreme. It's quite famous, actually. The corporate office in Omaha, famously lean, minimal staff. Day-to-day operations, strategic planning, that's all handled by the managers of the subsidiaries themselves. Their main jobs really are simple. Send in monthly financial statements and remit any excess cash back to Omaha.
And the cash then gets reallocated by Buffett and the team.
Precisely. It goes back to Omaha for reallocation across the whole Berkshire ecosystem, wherever they see the best opportunities.
That structure, that decentralization, it sounds like it leads to just immense diversification of income. How does that actually look when you break it down?
It's a perfect illustration of the strategy and, a core reason for their resilience. If you look at the fiscal year 2024 revenue data, the diversification is striking. The insurance group, which many people associate strongly with Berkshire, is the largest segment, sure. About 28.3% of revenue, around $105 billion.
Okay, still a big chunk.
A very big chunk, but it's far from the only piece. Manufacturing businesses bring in nearly 21%, that's $77 billion. Then you've got McLean Company, the wholesale distributor, at 14%, or $52 billion. Pilot travel centers add another 12.6%, almost $47 billion.
Wow, it really spreads out.
It does. And then there's service and retailing at nearly 11%, Berkshire Hathaway Energy at 7%, and the BNSF Railroad at over 6%.
So that broad spread means if one area, say, hits a rough patch, others can often compensate.
Exactly. It makes the whole entity incredibly resilient. One sector faces headwinds, others often pick up the slack.
That resilience is key. Okay, so we've got the foundation of Berkshire. Unique model, diversified. How did it actually perform recently? Let's dig into their Q1 2025 earnings because, well, those headline numbers can be tricky.
Yeah, here's where it gets really interesting. And you're absolutely right. The headline numbers can be incredibly misleading. It's a point Warren Buffett himself makes constantly.
Because of the accounting rules, right? GAAP.
Exactly. Under GAAP, generally accepted accounting principles, companies have to include unrealized gains and losses from their stock portfolio in their net income. So for Q1 2025, Berkshire reported this sharp decline in GAAP net earnings. It went down to $4.60 billion from $12.70 billion the year before.
A huge drop.
Looks huge. But it was almost entirely due to a $5.0 billion investment loss, which included about $7.4 billion in unrealized losses from their massive stock holdings. Paper losses, essentially based on market fluctuations.
And Buffett says ignore that.
He consistently tells investors to disregard those volatile figures because they don't reflect the actual health of the operating businesses. The far truer measure is operating earnings. That strips out these big investment swings.
Okay, so what do those look like?
For Q1 2025, operating earnings were $9.64 billion. Now, that was a modest decline from $11.22 billion in Q1 2024, which is understandable given economic conditions, but it still shows the consistent cash-generating power of Berkshire's diverse businesses. Much clearer picture.
That distinction is absolutely vital. JAP versus operating. Got it. So beyond that overall operating picture, what did you see when you looked deeper into the individual segments?
Yeah, it was definitely a mixed bag, as you'd expect with such diversity. Take the insurance group, kind of a dual story there. Underwriting income, the profit from actually writing policies that fell quite a bit, $1.34 billion, down from $2.60 billion.
Why was that?
Partly a more challenging environment, but also some specific events. They had estimated $850 million in after-tax losses just from the wildfires in Los Angeles, California. Catastrophe losses hit them.
Oh.
But on the flip side, insurance investment income actually rose, went up to $2.89 billion from $2.60 billion.
How come?
That was a direct result of higher interest rates. All that cash Berkshire holds from premiums, the float, it was earning more interest while just sitting there waiting to pay claims.
Interesting. What about the other big pieces? Railroad, energy.
Well, BNSF Railway showed really impressive stability. Earnings actually ticked up slightly to $1.21 billion, very steady. Berkshire Hathaway Energy, BHE, that was a real standout. Earnings surged to $1.1 million, way up from $717 million the year before. Shows the strength of its regulated utility model.
And rest. Manufacturing, service, retail.
That huge varied segment reported largely flat earnings, about $3.06 billion. It kind of reflects the mixed economic currents impacting all those different businesses within it, from industrial stuff to consumer brands.
Makes sense. And all this brings us to another one of Berkshire's huge strengths. That fortress balance sheet.
Yeah.
How's it looking these days? Still rock solid.
Oh, absolutely. Fortress is the right word. It's a cornerstone of their whole long-term strategy. Their insurance float, that premium money they collect up front and invest, it kept growing. Reached $173 billion by the end of March 2025.
That's just a massive amount of low-cost capital for them to work with.
It really is. And then there's the cash hoard, the massive cash and short-term U.S. Treasury bill holdings. These are now a significant earnings contributor themselves. That other segment in their reporting, which includes income from these holdings, its interest and dividend income just surged. $869 million in Q1 2025, up dramatically from only $303 million the year before.
Wow, just from interest on cash.
Exactly. And by the end of Q2 2025, that cash pile had grown even larger, an astounding $344 billion.
$344 billion.
Yeah, it creates this sort of barbell effect. On one end, you have these ultra-safe assets, treasuries, generating high, pretty much risk-free returns right now because of interest rates. On the other end, you have their super durable operating assets like the railroad, the energy utilities, providing this stable earnings foundation.
So they get yield from safety and stability from operations.
Precisely. It lets them easily absorb short-term bumps, like from their stock market investments, and gives them just immense flexibility options.
And for you, the listener, understanding these things, the difference between GAAP and operating earnings, the power of that float, the sheer strength of the balance sheet that's absolutely vital for getting a real read on Berkshire's actual performance. It's easy to get swayed by headlines, but this deeper look tells the real story.
Okay, but even a fortress like Berkshire faces challenges, right? It can't all be smooth sailing. What are the big risks on the horizon? No, you're right. There are definitely significant risks. The most profound one, and it's widely discussed, is the long-term risk around leadership transition.
Meaning Warren Buffett's eventual departure.
Exactly. He's 94. Gregory E. Abel is the designated successor. We know that. But Buffett's eventual departure still introduces uncertainty about the unique culture, about that famed capital allocation skill. I mean, the 2024 annual report itself said the unavailability of key personnel, especially Mr. Buffett, could have a material adverse effect. They acknowledge it directly.
It's candid. What else?
Well, there's the size problem. It's a recurring theme. Berkshire is just so immense now, it's increasingly hard to find acquisitions big enough to actually move the needle on overall performance.
Which explains that giant cash pile we just talked about.
It's a primary reason, yes. Finding great businesses at reasonable prices that are large enough for Berkshire, that's a real challenge. Then you have short-term risks. Economic sensitivity, we saw earnings dip at places like Fruit of the Loom, Jazzwares, partly due to international trade policies impacting them. And of course, the insurance side is always exposed to potential mega catastrophes like those LA wildfires hitting Q1 earnings.
Right. Any regulatory stuff.
Yeah, there's growing regulatory scrutiny. especially around climate-related policies impacting BNSF and BHE, the railroad and energy segments. Together, they account for over 90% of Berkshire's direct emissions, so that's definitely on the radar.
Okay, that's a good overview of the risks. But here's something I find fascinating. How does Berkshire Hathaway itself stack up against Warren Buffett's own very strict investment checklist? So what does this all mean when you hold Berkshire up to the Buffett standard?
That's a great question, and it leads to a really nuanced, almost paradoxical answer. While Berkshire absolutely embodies the spirit of a great Buffett-style company, its sheer size and those GAAP accounting quirks mean it sometimes, well, fails its own founder's quantitative tests.
Really? How so?
Okay, let's run through some of the key quantitative criteria Buffett often talks about. First, valuation discipline. He likes a low PE ratio, typically below 15, and price to book below 1.5, maybe even 1.2. On PE, Berkshire is a fail. Its GAAP PE is wildly volatile because of those investment gains and losses. It was even not applicable in 2022 because they had a net loss under GAAP.
Okay, so PE is out. What about price to book?
That's borderline fail. It's consistently traded above 1.2 times book, often above 1.5. It hit 1.51 in 2024. So by that metric, it doesn't consistently look on sale.
Interesting. What about cash generation?
Cash generation and allocation. Here it's a clear pass, positive free cash flow every year, yes. FCF as a percentage of revenue typically above 5%, yes. Berkshire is a cash-generating machine.
Good. Growth and predictability, EPS.
Growth and predictability. Looking at the EPS record, it's a fail. Again, that's because the JAP EPS jumps all over the place. Impossible to show consistent growth there.
Well, what about book value growth?
Yeah.
It talks about that too.
Right, and on the 10-year compound annual growth rate in book value per share, that's a pass. It grew at 11.1% from 2015 to 2024, meeting his benchmark of over 10%.
Okay, so mixed on growth. How about safety? Balance sheet.
Balance sheet safety. This is another strong point. Debt to equity ratio less than 0.5, a definite pass. It was incredibly low at 0.19 in 2024. Interest coverage needing to be greater than 3 times, another resounding pass. It was extremely high, over 22 times in 2024. They can easily cover their debt.
Rock solid there. Lastly, profitability and efficiency metrics. Margins, ROE, ROIC.
Right, profitability and efficiency. Gross margin greater than 40%, that's a pass. Consistently very high, around 79% recently.
Well, net profit margin.
Fail. Too volatile because of GAAP. It was even negative in 2022. Doesn't meet the 20% plus consistency test. Return on equity, ROE, averaging 15% or more, also a fail. It averaged only about 10.4%. And return on invested capital, ROIC or ROTC, averaging 12% or more. That's a fail too, averaging around 7.2%.
Wow. So the irony is palpable, isn't it? A company built on these strict value principles doesn't always check all the quantitative boxes using its founder's own criteria.
Exactly. It really underscores Berkshire's unique nature, its scale. Some standard rules of thumb just don't neatly apply anymore. The qualitative factors become even more important.
Well, let's shift gears then and look directly at those qualitative strengths. Things like the management, the governance structure. That seems core to the Berkshire identity.
Absolutely. This is where Berkshire truly shines, and it's why so many people admire the company, frankly. The management team is defined by incredible longevity and a really deep understanding of their businesses. You've got Warren Buffett, still chairman and CEO at 94, Gregory Abel handling non-insurance operations, Ajit Jain heading insurance, Mark Hamburg as CFO, decades of experience at the top.
And the culture they foster?
It's remarkable for its transparency and honesty. Buffett's annual letters are legendary for their candor. I mean, he famously used the words mistake or error 16 times just between 2019 and 2023 in those letters.
Which is not typical corporate speak.
Not at all. He contrasted himself with the usual happy talk. And they don't do the typical quarterly analyst calls either. Instead, you get those multi-hour Q&A sessions at the annual meeting. It treats shareholders like long-term partners, not just numbers on a spreadsheet.
And the alignment between management and shareholders. That seems crucial too.
Exceptionally strong. Warren Buffett himself owns 14.3% of the company, giving him over 30% of the voting power. The board members are required to have significant skin in the game through stock ownership. And Buffett's salary. It's been a nominal $100,000 a year for decades. His incentive is purely tied to growing the long-term value of the business for all shareholders.
That strong alignment really stands out. So who actually owns the rest of Berkshire? And how much influence do they have?
Well, beyond Buffett as the controlling shareholder, the big owners of the more liquid Class B shares are the usual large institutional players. Vanguard has about 11%, BlackRock around 8.3%, State Street over 5%.
Mostly index funds tracking the market.
Largely reflects Berkshire's huge weight in the major indices, yes. But what's interesting is, despite this big institutional ownership, shareholder proposals that kind of clash with Berkshire's unique decentralized model, they consistently get defeated.
Like what kinds of proposals?
Things like demanding centralized reports on emissions or diversity metrics across the whole conglomerate. The board consistently recommends voting against them. Their argument, which aligns perfectly with the core strategy, is that those issues are best handled by the individual managers of the subsidiary businesses, not dictated from Omaha. And shareholders, including Buffett's controlling stake, seem to agree.
That makes perfect sense within their philosophy. Now, speaking of management's actions signaling things, one of those powerful signals they send is through share buybacks.
Oh, it's an absolutely crucial signal for anyone watching Berkshire. Critically important. Remember, they amended the buyback program back in July 2018.
Right. They removed that old rule limiting buybacks to 120% of book value.
Exactly. And since then, up until March 2025, Berkshire spent nearly $78 billion buying back its own stock, a massive amount, which significantly boosts the per-share intrinsic value for the shareholders who remain.
But something changed recently.
A really dramatic shift, yes. In late 2024 and carrying into 2025, the share repurchase activity slowed dramatically. In fact, it basically halted completely for a period.
And this happened just as the stock price was going up.
Precisely. The timing isn't coincidental. This change, this halt and buybacks, it's one of the most direct and credible signals you can get from Warren Buffett himself. The authorization for buybacks is explicitly stated: only repurchase shares when the stock trades below management's estimate of intrinsic value.
So stopping the buybacks implies?
It strongly implies that management no longer believed the stock offered a compelling discount to its intrinsic value at those higher prices. It's like a real-time data point suggesting the shares might be fully valued, or close to it, in the current market.
That's fascinating. It's like Buffett telling the market it's not cheap anymore, through his actions, not just words.
Exactly. It corroborates the whole idea that maybe Berkshire isn't the screaming bargain it might have been at other times.
And it's interesting, you mentioned other big-name value investors earlier, like Bill Ackman or Seth Klarman. They don't seem to hold Berkshire.
Right. And that absence might well be linked to this. The size problem makes it hard for Berkshire to grow rapidly, and if there isn't a significant discount to intrinsic value, it might not meet the criteria for funds like Pershing Square or Bopos Group, which often look for those specific types of opportunities.
So these actions, these insights from leadership, they really can tell you so much more than just the numbers on a spreadsheet sometimes.
Absolutely, especially with a company like Berkshire, where management's integrity and signaling are so highly regarded.
Okay, so after covering all this ground, the model, the financials, the risks, the management, the signals, we arrive at the critical question for any investor. What about the actual intrinsic value? So what does this all mean for its true worth?
Right, the bottom line. To get a handle on that, a discounted cash flow, or DCF, valuation analysis was done. Crucially, it focused on owner's earnings, which is the metric Buffett himself favors.
Can you briefly explain owner's earnings again? How's it different from net income?
Sure. Think of it as net income plus depreciation and amortization, which are non-cash charges, but minus the capital expenditures that are needed just to maintain the company's current level of operations. Maintenance CapEx, basically.
So it's the cash left over after keeping the business running as is.
Exactly. It gives you a truer picture of the cash flow that's really free for the owners to potentially take out or reinvest for growth after accounting for the costs of just staying in place. It aims to strip out accounting noise and focus on real cash generation.
Okay, so applying that DCF model using owner's earnings, what did it suggest for Berkshire's value?
Based on the analysis, the nominal or base case scenario pointed towards an intrinsic value of approximately $510.45 per Class B share.
$510.45 per share. And how does that compare to where the stock has been trading?
Well, Berkshire's stock price has certainly been elevated, often trading significantly above the levels suggested by applying a margin of safety.
Ah, the margin of safety. How does that factor in?
It's a core principle of value investing. You want to buy significantly below your estimate of intrinsic value to protect yourself if your estimate is wrong or things don't pan out as expected. If we apply a typical 25% margin of safety to that $510.45 estimate, that would imply a potential buy price target of around $382.84 per share.
$382.84. So a fair bit lower than the calculated intrinsic value, providing that buffer.
Exactly. That's the discipline.
So pulling it all together, what's the final investment thesis coming out of this deep dive in the source analysis?
It's really one of, I'd say, cautious admiration. Berkshire Hathaway is undeniably a corporate fortress, unparalleled financial strength, fantastic management integrity, a collection of really high-quality cash-generating businesses. You can't deny that. But at recent market prices, it doesn't necessarily fit the mold of a textbook deep value investment, primarily because of its immense size, which limits explosive growth potential, and the volatility that GAAP accounting rules introduce, making traditional valuation metrics look messy. And as we discussed, Warren Buffett's own actions, slowing the buybacks, letting that cash pile grow, seem to directly corroborate this assessment that it's not significantly undervalued right now.
So what's the takeaway for someone thinking about Berkshire?
Ultimately, the view is that while Berkshire remains an absolutely exceptional quality core holding for a long-term investor, maybe someone already holding it, new capital, might benefit from some patience. Waiting for a more opportune entry point, perhaps during a period of broader market stress or a pullback in the share price, might be prudent. That's historically when Berkshire has really shown and offered compelling long-term value.
What a really comprehensive deep dive into Berkshire Hathaway. We've touched on so much: that unique decentralized structure, the diverse income, the vital difference between GAAP and operating earnings, the risks, how it stacks up against its own standards, and those powerful management signals like the buybacks. So here's a final thought for you, the listener, to maybe ponder. Given that immense $344 billion cash pile and that persistent size problem, the difficulty of finding acquisitions big enough to matter what might be the next truly innovative way this unique company leverages its strengths is going to be a massive acquisition we haven't even thought of, some entirely new internal venture, or maybe something else entirely that just defies our current expectations. Something to think about. And always remember, reflect on that balance between the numbers, the quantitative stuff, and the crucial qualitative aspects of any business. And please, always conduct your own due diligence before making any investment decisions.
That's right. All the analysis we discussed is based on publicly available sources. It could be subject to revisions or different interpretations. And crucially, this content is for educational purposes only. It absolutely does not constitute investment advice.
Well said. Thanks for joining us on this deep dive.